Welcome back to Market on Close. I'm Caroline Woods. It's time to dive deeper into the U.S. and China's trade agreement. For that, let's welcome in Thierry Wizman, global FX and rate strategist at Macquarie. Terry, thanks so much for joining the show.
Pleasure. Good afternoon.
So we had a guest on earlier today saying basically worst case scenario now off the table with these developments, even though they're temporary cuts to these sky high tariffs. Want to get your thoughts on the deal because I guess lack of a deal, but on this development, because the market is clearly celebrating it.
Yeah, no, I appreciate your hesitation there because this is not really a deal. This is just an agreement to undo the most egregious parts of the reciprocal tariffs and then the retaliation to the reciprocal tariffs that the Chinese put on. And my sense is that there's still quite a lot of daylight between the U.S. Remember that at its heart, the problem that the U.S. faces is China's, state-led capitalism system, right, which creates and captures advantages in technology after technology and product after product. And even after President Biden's industrial policies, which President Trump is now disavowing, the U.S. has really nothing comparable to this. And I don't think China's about to jettison this system, yet, despite the fact that the U.S. is pleading China to do so, right? It's a system that has served China pretty well. And if they do jettison it or get rid of it, it's really not going to be in 90 days. Remember also that China has some, powerful allies in the U.S. who like cheap labor and the cheap inputs that China produces and are dependent on those supply chains. So coming to a point in the 90 days where we get some sort of grand compromise where both sides make, new and innovative promises to the other, I think that's doubtful. I think that it's a much better, there's a much higher probability that the U.S. makes much more progress with those countries that are its allies, that have systems that are shared with the U.S., that have a point of view with regard to how to manage an economy that are similar to the U.S. That's where you would expect progress to be made, real progress to be made relative to these so-called trade agreements going forward.
So Terry, would you take a look at the market and the fact that the S&P is up 3% today, the Dow's up more than 1,000 points, and say that this is unwarranted, that it's not justified?
It's not unwarranted because had we stayed with those very egregious tariffs, we probably would have seen a complete disruption in the system of trade and the movement of products across borders between the U.S. and China. So it's not unprecedented in the sense that the prospect of seeing store shelves bare and barren sometime over the next few weeks has dissipated. That's good too, of course, because that would have caused political problems in the U.S. for this administration, and it could not have gone forward with the rest of its agenda. So the market's cheering a little bit here in the sense that the worst, like you say, the worst is not going to happen. But that doesn't mean that we're going to see, the U.S. and China be best friends forever going forward. That's going to take a lot of time. And a grand compromise is going to be very, very difficult to come by.
So you'd say the prospects for a lasting agreement with China are what?
Look, it depends on how broad, how many subjects are covered here, whether it covers IP protections, whether it covers Taiwan, whether it covers the misalignment of the Chinese currency. I mean, the kind of package that you would need to resolve all those issues, the probability is very small. Even in the next year, I would say less than 5%. The possibility that we get something like we saw in the first Trump administration, where China agrees to buy a certain, amount of U.S. goods, and then we call the whole thing off, at least for now. That's likelier. That's certainly not going to create, it's not going to create a situation where China is no longer the U.S.'s strategic competitor, no longer a strategic threat to the U.S. For that, you would need a lot more, and I don't think that's happening. China has ambitions, the U.S. has opposite ambitions, and there's no way to reach a compromise when it's a question of who's going to be at the top of the system globally in the next 20 years. It's going to be one or the other. It can't be both.
There were questions about why we're implementing these tariffs after all, and one of the potential reasons was because they wanted to keep these tariffs in place to bring manufacturing back into the U.S. Based on this development, it doesn't necessarily seem like that's the overall goal here.
Well, look, keep in mind that these tariffs are not going away. You still have the fentanyl tariffs. You still have the tariffs that date back to 2018. You still have the 10% base, or universal reciprocal tariffs. Tariffs on China are still going to be high, even compared to other countries, after all is said and done with this little deal we've gotten over the weekend. As far as bringing manufacturing back to the U.S., that is clearly one of the ambitions of this administration. Not because they want to create jobs necessarily. That may be a side benefit of bringing manufacturing back. But keep in mind that manufacturing is increasingly automated these days. It doesn't really necessarily create jobs. No, the real reason to bring manufacturing back to the United States is to improve the U.S.'s strategic and defense position. China has about 6 times the forging and casting capacity than the U.S. does. If there were ever a point in time, where we had to call up industry to serve up weaponry for a war, it would be difficult to ramp it up very quickly vis-a-vis China. So you bring manufacturing back in the U.S. so that you can have a system of defense when you need it, right? And I think this speaks to what President Trump had said a very long time ago. If you don't have steel, you don't have a country. Like he said about the border. If you don't have a border, you don't have a country. Well, if you don't have steel, you don't have a country either, because you can't defend a country, at least not from a mechanized perspective. So that's one of the key reasons for bringing manufacturing back. It's going to take a long time for that to be accomplished, though.
Yeah, and to your point, 30% seems low compared to 145%, but it's still 30%, at least for the next 90 days or so. And even 10% tariffs could have an economic impact. So while this might bring the worst case scenario off the table, does it bring a recession off the table, or is that still a real concern in terms of the economic impact of these tariffs?
If it was just these tariffs, I would say no, they're not high enough to be recessionary. But keep in mind that there are other underlying trends in the U.S. economy that seem weak to me right now. The low-income household seems weak and seems to be financially in some distress. Housing seems to be too expensive for most households to reach. So from that perspective, I don't think that the consumer feels that confident. Now, if you were starting from the situation where the consumer was strong, then these tariffs would probably not cause a recession. But there are underlying weaknesses and underlying trappings here that when you pile on even a modest amount of tariffs, call it 15% across the board or 10% across the board on average for the U.S., you could cause something that looks like a recession.
Okay, we're looking at a higher dollar today. What does this mean for the dollar a little bit longer term, though?
Not that much. I mean, the reason the dollar is stronger today is because people in the world are looking around and say, oh, wow, the U.S. is finally engaging the rest of the world again. Certainly, if you can make a deal or sit down with China, you can sit down with anyone. And therefore, American economic diplomacy is back, and we don't have to worry too much about the erraticism of U.S. policymaking and the uncertainty around it. That might be the case. That might be the signal that we're getting because of this so-called deal with China. But keep in mind, this is still the same administration in Washington. It still tends to do things in a haphazard, abrupt, and instinctual basis, let's say. There's still going to be plenty of policy uncertainty going forward. And the dollar is still expensive, even after all has been said and done in the last few weeks. I still think that cross-border asset allocators around the world are still going to diversify away from the dollar and into the other currencies over the next few months. And that could mean that we revert back to some, modicum, some degree of dollar weakness over the next 6 to 9 months again.
Okay. And finally, what do you think it means for the Fed?
Well, I think the Fed, if it was unhappy before, I think it's still unhappy, but it's a little less unhappy. To some extent, this resolves some of the tension in the dual mandate. If you don't have tariffs that are as high, if you don't have store shelves that are going to be barren, you can worry a little less about inflation instead of a little more. You might be able to worry a little less about the prospect for a deep recession as well. What it means for the Fed is that the tension, the need to raise rates in view of that inflation kind of diminishes a little bit, but also the need to reduce rates in view of a prospective recession diminishes a little bit. I think the net effect, as we're seeing in the market today, is the market is okay to simply say, look, instead of maybe 3 cuts this year from the Fed, we get 2. We think that is a little bit too much. We would pin our hopes a little bit on even less of an easing by the Fed this year. But that's our view.
Okay, but you're saying recession risk still very much on the table because of what you're seeing from a lower income consumer. Is a recession in your forecast, though?
No, it is not.
Okay.
We do project a slowdown, and certainly in the second quarter we'll see one. because there's still going to be those disruptions and the ratchet effect from all those purchases that took place before the implementation of the tariffs. That's going to cause some distortions. It's probably going to be reflected as a slowdown in the second quarter. And if it's negative in the second quarter and you see two back-to-back quarters of negative GDP growth, some people might call that a recession. I wouldn't necessarily call it a recession. The NBR might not call it a recession. But the premise here, and again, we don't really know where these tariffs are going to end up. But a slowdown seems to be inevitable in the second quarter. If we recover after that, it may not be because we get rid of the tariff so much, but remember, there's other things in the policy agenda of this administration that might be able to kick the economy back up in the third and fourth quarter. Deregulation is one of them, maybe tax reform. So when you consider the totality of things, the weakness of the consumer, the prospect that some of these tariffs will be walked back, the prospect that we're going to see deregulation, if you take the totality of all those things, the answer is no, we will not see a recession.
Okay. All right. Thierry Wizman, global FX and rate strategist of Macquarie. Appreciate you breaking it all down for us and helping us make sense of these developments. Thanks so much.